Hi there, I'm Joseph Quijano, Certified Financial Planner with Become the Banker.
And I'm Jordan Quijano. We again want to thank you for watching the first part of really what the right life insurance is for the Become the Banker concept. You've come to part 2, so if you haven't watched the first part, please go ahead and click the tab above to take you to the first video. This is going to be some great information, so go ahead, pull your notes out, and let's carry on to the second part.
With a Become the Banker strategy, we're going to be concentrating on whole life. Whole life is the key. It is the foundation of the Become the Banker policy. But it has to be a very specialized form of whole life that not a lot of companies offer. And not a lot of agents or financial advisors will tell you about it. Now, we're going to talk to you about the whole life policy. And we're going to talk to you about the specialized whole life for the Become the Banker strategy. Now, if you look at a whole life policy, this is a way that most whole lives normally are, right here. And I want you to see this diagram here. One of the traits of a whole life policy is that you have a level premium. That means that once you establish the policy at your given age, that premium will remain the same no matter how old you live, unlike term insurance that keeps increasing. This is a level premium for the rest of your life. So you begin at a certain age right here, and the policies today will go to age, get this, 121. Can you believe that? 121 years of age. So if you start a policy when you're 40, 30, whatever, that premium will remain the same level till the day you pass. That's guaranteed. That's guaranteed. Now, they also have a death benefit right here that is level. It's not going to be increasing or decreasing. Okay, that's the normal whole life policy. And then that third feature of a whole life policy is that after a few years, normally 3 years, it begins to build cash value. And here's the cash value growth right here.
Or equity.
Or equity, right. And I want to make sure that you really see this, because this cash value line doesn't go like this.
Right. Where it could on the variable.
Right. It's not like the stock market. I mean, this is a guaranteed growth that goes from the time it begins to grow, which is normally after 3 years, all the way to your age 121. It will never drop. It will just keep on growing.
Right.
It is actuarially sound because at the age of 121, that cash value will have to mathematically equal the death benefit. It has to equal it.
Yep.
Now, this type of policy is the normal whole life policy. The whole life policy for the Become the Banker strategy has to come from a mutual company. And a mutual company actually has no ownership. That means that they sell no stock because they have no stock to sell. They have no shareholders, no stockholders.
Right.
So who owns the company?
The policy owners. It's very much like a bank and a credit union. You got stock-owned life insurance companies that are operate just like banks. You can be a member of it, you can be a depositor, I should say, and when that bank profits, you as a depositor, you don't get anything. You just get the going interest rate they're giving you. Their profits go to the stockholders and the shareholders. Whereas a credit union, on the other hand, like a mutual company, just like my father mentioned, there are no stock owners, there are no shareholders. It's mutually owned by all the policy holders or all the members. So when you bank with a credit union or a mutual life insurance company, not only are you going to get the going rate that they're giving you on your account, but they also share the profits with you and I in a form of a dividend. And that's where the Become the Banker really strives.
And that's the beauty, isn't it?
Yes.
Now, with the cash value growth right here, the company will base it on a 4% growth right here. 4% growth.
Guaranteed.
Guaranteed cash value return. Plus dividends, okay? So every year when the company makes a profit, they will share those profits with people like you and I, Jordan.
Exactly.
So they're going to give dividends, okay? And the dividends, you can actually use them in different ways. You can pay your premiums with it. You can receive them in cash. Yeah. You can just buy more life insurance with them, or you can just reinvest it, okay? Yeah. But the dividends that work the best with the Become the Banker policy is what they call paid up additions, or I'm going to put down here PUA. Paid up addition. Now, what does the word paid up mean?
You own it. It's paid up.
No more premiums, right?
Yeah.
So just imagine that this mutual company gave you a dividend, and with that dividend, you were able to purchase, with that dividend, 3 little paid up additions. The paid up additions are actually just like the main policy. They have a death benefit. They have a cash value from day one, 4% return, right?
Yeah.
But no premium. They're paid up. So they're worth their weight in gold.
Yeah.
They're liquid. So, and guess what else? Each one of these little paid up additions, because they come from a mutual company, what are they going to give you?
At the end of the year, you get dividends as well.
Dividends again. So each one of them will give you dividends every year. And what do you do with them? You buy more paid up additions.
And looking at this, I think the easiest way to look at it and understand it is a Hershey bar. You look at those big Hershey bars that you can get during Valentine's Day or Walgreens, just the big old ones, £1, you know? And then you can buy the little Halloween ones, the little snack ones that you pass out. Now, at the end of the day, both of them have the same chocolate. They're both the same Hershey bar. They're both the same, company. They both came from it. But the size is what's different. So when you look at the main policy, that's your big Hershey bar. And as my father mentioned, these dividends are basically those little quarter Hershey bars that they get handed out every year at Halloween. And that's how this keeps on multiplying.
Absolutely. Now, excellent example, Jordan. And here's the key. You know, most people don't want to wait 3 years for the policy to build any equity. They want to start using their cash today. Because people who that become the banker strategy, they're not really interested on the death benefit.
It's a component, but that's not the main
reason.
reason.
They're not interested. I mean, they're more concerned about the living benefit. They want to be able to use their money today to finance purchases and pay themselves back.
Right.
Right.
And this 3-year, just one more point, this regular whole life, I have to say, this is what usually gets that negative tag where you hear from the Dave Ramseys, the Susie Ormans, which all have got, good advice for most stuff, but that's typically the life insurance they're talking about, is regular whole life that has 0 in cash for about 3 years because of that cost. Well, with the Become the Banker, as my father's about to mention here, that's not the case. You have day one liquidity.
Get ready for this, okay? Because, I mean, if you don't like waiting 3 years to start building equity in your policy, you can build the equity day one. Day one. And that is by designing the policy with what they call a rider or an attachment to the policy. It's almost like a bucket attached to the main Hershey bar right here. And that Hershey bar, or the big bucket here, is called the single premium PUA rider bucket. And then there's another bucket attached to that, and it's called a flexible premium PUA rider. So that means that if people watching this video today, if you have a lump sum of money now working for you at a bank account, making you less than 1%, this is where the single premium could be beneficial.
Absolutely.
You can put the money right here into this account, and guess what? Just like the name states, you're going to buy a whole bunch of what?
Little baby Hershey's.
Little baby Hershey bars.
Or paid up ones.
Okay, paid up ones. Okay, so building cash. And then if you want to do additional premiums, you can actually put part of the premium here and part of the premium right here.
Yeah.
So that means that you have immediate cash day one to utilize to do your financing and become your own banker. How good is that?
That's the beauty of this. With these two accounts, you've got that 4% plus the dividends, like we said, which are about 1%. Let's just say conservatively. That's growing on the account immediately, day one. And this Flex PUA, or the Flexible Premium Paid Up Additions rider, that is the component that really sets the Become the Banker whole life away from any other life insurance plan. The design is to make sure that your monthly or your annual premium typically has that split going maybe 60-40, depending on your age and your health, where 60% of it is going in there day one. The other 40% is going in to cover this cost. But after you get to that point where the cost is met, then this is just skyrocketing with cash, and it starts to snowball. Or in some cases, maybe it's 30-70 because of your age and you're going to college and you're trying to really stuff it in there. The only rule, not the only, but the main rule we have to abide by, and the IRS puts this in place, is what's called a MEC line. And that MEC line is what decides if your policy is taxable or tax-free. The whole idea would be, it'd be great to put 90-10, or 10-90, but then you wouldn't have enough death benefit to qualify it as life insurance. And that's what keeps everything tax-free under this MEC line, is making sure that your death benefit has to always be a little bit higher than your cash at all times to qualify it as life insurance, so you can get the tax-free treatment and have everything we're talking about here. So when we sit down and meet with individuals, that's our whole design, is to figure out what is that split that we can do without hitting the MEC line. And if you have that single premium, day one you put it in there, it's switching money from your left pocket to your right. You can use it day one, it's liquid day one, there's no commission cost, there's no fees, there's no death benefit, you have access to it immediately.
When you deal with companies like our company, you never have to worry about the MEC.
That's right.
We'll make sure that the policy will always qualify tax-free.
Yep.
Now, I do want to mention one point, and this point is very important. Life insurance companies, I'm talking about all life insurance companies, they don't want to have you put money in today and take money out tomorrow. They don't want to do that. They want to make sure that you put the money in and never have to take it out until the day you pass away.
Right.
That's how they make money.
Yeah.
Okay, so there's only a handful of companies that are willing to design a policy like this for the Become the Banker strategy that will allow you to take money out day one.
That liquid.
Day one. Not having to pass away, but I'm talking liquid cash day one. And when my son was explaining to you the premium split of 40% going to the big Hershey bar or the base, and 60% of the premium that you're putting in going to the right, or it's your money, it's cash, free cash. This is the reason why. I'm going to give you the answer. A lot of people ask me, why haven't I heard of this concept before? It's beautiful.
Yeah.
Why hasn't my agent or my stockbroker told me about this concept? Why doesn't my life insurance company promote this? You know why? Because commissions, ladies and gentlemen, commissions are paid on the big Hershey bar right here. So people that sell, that Become the Banker strategy, and they do it properly with whole life, they only make commissions on the 40% of the premium.
Right.
While another agent will make commissions on 100% of the entire premium.
So true.
So, as consumer advocates have said,
Yes.
the whole life policy with the Become the Banker strategy is a consumer-driven policy.
Absolutely.
The agents promoting this concept, the companies designing these policies are for you, the consumer, not for themselves, and the agents are not for themselves either. They're for you, for your benefit. Companies that do away without it,
They're company-driven.
they're company-driven,
And
agent-driven
agent-driven policies.
companies. Okay, so that's the difference, okay?
That's a good point. So this might be a little bit to digest, but when we meet on a one-on-one, this is what we cover. We figure out what that split is, what the death benefit is, if you have a single premium or not. But we really just want to help take you by the hand and show you how you can build this wealth absolutely tax-free, get a guaranteed rate of return, and of course use it today.
Absolutely.
Especially if you have debts that you're wanting to pay off. So we want to thank you for watching this video with us today. We really appreciate any comments you leave, any questions, and again, feel free to reach out to us directly so that we can help you out individually. I'm Jordan Quijano.
And I'm Joseph Quijano. And again, subscribe to the channel if you haven't subscribed to it. Like the channel, hit the notification bell so we can keep informing you about the wonderful, wonderful strategy of becoming your own banker.